Talk of the town has really been Swiggy and its first numbers post its listing. So let me welcome on board Sriharsha Majety, the MD and Group CEO, and Rahul Bothra, the CFO at Swiggy, both joining in on the show right now. Harsha, if I could, or Rahul actually, let me come to you first on the overall consolidated EBITDA loss and the net loss, which has widened on a sequential basis. Explain to us what's adding to the pressure on the bottom line and when is it that we can expect the loss to start narrowing?
Sure. So I'll take that. So basically, if you look at our overall numbers, we have improved our adjusted EBITDA by 30% in our B2C GOV businesses over the last year with an improvement of 147 crores. So the operating numbers there, this is the key. Now, if you look on a sequential basis on a quarterly number, there is a slight increase in our loss due to the share-based compensation cost that has gone up. We have given a certain amount of performance ESOPs grants to management. A lot of these ESOPs are linked to performance of the share price, and therefore it completely aligned to shareholder interests. 55% of the expected ESOP cost is actually linked to the performance grants. So this is the marginal increase that we have seen. However, on a year-on-year basis, we have seen a 5% reduction in our reported loss, despite a 91 crore increase in our ESOP charge. So I think we have to see it in the light of both the yearly context as well as the quarterly context. Also, if I may add, the food delivery business EBITDA has actually doubled on a sequential basis. So from a 57 crore number, this number has now come to 112 crores. So we have doubled our operating margin in the food delivery business from 0.8% to 1.6%. The quick commerce business, we have seen a slight reduction in the reported EBITDA loss. That's because of the expansion that we have seen in the overall and the growth trajectory, which has also accelerated. So sequentially, we have grown 24% versus the previous quarter of 17%. So the expansion of the dark store footprint has resulted in a incremental quarterly loss, but on a YOY basis, we have seen again significant improvement in the contribution margin trajectory as well as the EBITDA percentage trajectory.
Okay, Rahul, thanks for that explanation. So clearly the ESOPs are directly linked to the share price as well, but you have guided for a steady state take rate and contribution margin to expand to 20-22% and 8 to 9% respectively, which will mean that the adjusted EBITDA margin should be around 4 to 5%. But what exactly is the timeline for this?
Yeah, so we have given a guidance specifically both the contribution margin, neutrality, which will happen in the December 2025 quarter, and the adjusted EBITDA guidance 3 quarters from there on, which is in the September 2026 quarter. The guidance on this is on the EBITDA profitability. From there on, you should expect anywhere between 8 to 12 quarters for steady state profitability to be hit, which is the 4 to 5% guidance that we have given on the EBITDA line.
Right. Rahul, is the food delivery PAT growth rate of 81% sequential and GOV rate of 5.6 sustainable, you think, on a sequential basis?
See, on the margin front, we are guiding that this business has the potential to get to 5% positive EBITDA. And it's a combination of both, our take rate, which will increase, as well as some cost reduction that we are seeing on the business on the delivery cost side by better utilization of our rider network and better efficiency and throughput per hour. And also the operating leverage, right? So even if you look at the last 12 months, we have delivered close to 90 basis points just in operating leverage as the business scales. So going forward from the 1.6% that we have been able to achieve in the recent quarter, we expect the steady state guidance of 5% to come through as a combination of these 3 levers.
Rahul, if I can just kind of indulge you more as far as the take rates are concerned, because in the quick commerce business, it's come down to 15.2% thereabouts, while the analysts believe that at least 19% is needed to face the competition. What's your view on that?
Yeah. So on this, there are 2 or 3 levers that we have. One is the advertising piece of the business. So from close to zero, say 6 to 8 quarters ago, today that business is substantially improved on a take rate basis for us. The other is the enablement services that we provide to the marketplace sellers. We have increased our overall infrastructure on the warehousing capacities as well as logistics network, and we continue to increase the bouquet of services that we provide to our marketplace sellers. So we do expect the take rate to be on a continual improvement path. And as we have written in our guidance, we do expect the take rate to be in the zip code of 20 to 22% at steady state.
Right. Rahul, let's shift focus from food delivery to quick commerce now. And the QCom net loss has also widened to about 317 odd crore rupees from the earlier 280 in the previous quarter. Tell me what led to this build-up in loss, and when is it that you expect the losses to come down?
As we had mentioned, it is largely on account of while the contribution margin has improved, from to negative 1.9%. We have seen expansion in both the marketing investments for the accelerated growth that we have seen, as well as some of the increase in the overheads to support the growth.
Okay, let me get Sriharsha also into the conversation, because when I look at your average, kind of value, order value, or the AOV, that has come down at 499 rupees per order versus Blinkit's, which is almost 660 bucks. What kind of growth are you eyeing in the average order value from here on, and is there a specific strategy in place to make that happen?
So I think if you if you look at the overall AMV journey, for us it's been a journey because we began originally in a 30-minute grocery only format, and over the last 1.5 years we've been upgrading our stores to larger sizes, and we've talked about that in the letter and the quarterly report as well. So that is happening as we speak, and in addition we're also stocking more and more SKUs every passing quarter. All of this coming together should mean that we're guiding that, let's say, the average order value can grow at a double-digit percentage pace every year for the foreseeable future.
Harsha, in a recent report on the QCom space, it suggests that Zepto has actually captured a slightly larger market share than Swiggy Instamart in the QCom sector. And now it's second to Blinkit. Pushing to Instamart number 3 on the ranking, what's the strategy to expand your market share and move up the chain?
We'd rather focus on our own growth and our own positioning in the market. And, if you look at, let's say, the overall last 4-6 quarters, I think we've gone to become like the fastest delivery speed player in the market. And our transformation right now is underway that allows us to add more and more assortment to the consumer. So for us, as we think about the overall positioning for Instamart in the category, building on, let's say, the momentum that we have, we want to go harder and harder on offering consumers incredible assortment, and then continuously iterate to figure out new categories that can fit into the quick commerce chassis. For example, we've run some experiments that are live already in the pharmacy category, and we'll continue to do more of these even in the future.
Okay, and if I also wanted to get a better sense from you, Sriharsha, regarding the dark store addition, because if I have it right, you've added 52 new stores in Q2. What's the pace that you're eyeing going forward? And let's say by FY25 end, what's the target that you want to achieve with respect to dark stores?
The guidance that we're currently giving is suggests that we'll be doubling our store footprint when you look at it year on year from March 24 to March 25. We're guiding for 1,050 stores in March 25. But if you also factor in, let's say, the average store size increasing, actually our overall square footprint is going to go up by 2.5 times by March 25 from March 24.
Right. Rahul, lastly, you reported a cash balance of about 4,500 odd crore rupees September end, which is significantly lower than your peers who have both recently carried out fundraising as well. How is it that you plan to remain competitive with your current cash balance, and are you also looking to jump on the fundraising bandwagon soon?
Right. So while we have seen some competitors raising, that's mostly what we believe is defensive capital. We have a very strong balance sheet with 8,000 crore plus cash balance existing with us. We have a profitable food delivery business that continues to accrue cash into the treasury, and the quick commerce business, as we said, will turn profitable in 6 to 7 quarters, for which there is substantial cash balance available with us. So there is no near-term fundraising plans for us.
Okay, gentlemen, on that note, we'll let you go. Thanks so much for making time and speaking with ET Now, and all the best for the coming quarters. For the markets,
if you like this video, then like, share and subscribe to ET Now.